Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is the first week of September, so September 3rd of 2024. Got one more month left in the quarter, and then we'll make the full cycle there into the fourth quarter to wrap up 2024. Now, September does tend to be seasonally a weaker part of the year for the market. If we look across the board, across history, September has posted the weakest results. Now, why is that? We don't really know. Part of the hypothesis there is that people come back from summer and they immediately start to clean up the portfolios at an institutional level, or any bad news that has been pent up over the summer months gets reflected as hedge fund managers, pension fund managers, portfolio managers in general come back from the summer holidays. But the other thing we're going to walk through today is the distinction of September performance when markets are in a pre-existing strong condition, in other words, a strong uptrend versus an existing downtrend. And there is quite the distinction there. So September can be okay and positive when the existing trend going into the month is strong versus when things are negative going into it. So we'll go over all of that this week. The update or the title of this week's presentation is Entering September, right? I know it is a scary time for a lot of people, a lot of bad memories in the month of September, Lehman Brothers. We go back to 1929, or we go back to Black Monday, which was obviously the first week of October, but that same part of the year. It's just a time of the year where a lot of market events have happened. But we've also seen the time of the year where, when we're in a healthy bull market, that trends power through the concern of the seasonality and end the year strong. So we're going to go through all of that. Three big things this week. What does the direction of market breadth tell us about the markets? Number two, how many rate cuts are currently being priced in and what do they mean? And of course, the last is areas that may benefit from a lower interest rate regime by the Federal Reserve. So if we look at breadth here, one of the things I do want to point out is that unlike late 2021 and 2022, growth investors don't necessarily have to worry about that deteriorating breadth line, right? So when we looked at 2022, one of the things that really hit our growth strategy was this deteriorating breadth that we saw. This time around, what we're seeing is new highs on the advanced decline line. Now, that hasn't been reflected in new highs in the market, but what that means is that more and more stocks are participating to the upside versus the downside. So that upside versus downside ratio continues to improve. It's nothing in markets are a guarantee, but when breadth is improving like that, it tends to be a symptom or a reflection of a healthy foundation for the market. Again, in 2022, we saw that decline led by further market declines in the future. Secondly, in terms of short-term momentum, right? So the top chart there is more long-term breadth, long-term trend. The bottom chart is more short-term momentum or short-term conditions. And we look at the percentage of stocks at a 20-day high after dipping in the early part of this week, obviously last week, pardon me. We know that the market was very choppy last week. That said, the percentage of stocks at 20-day highs has started to pop again. So we actually think that the momentum could be trying to pick up here. A lot of people were concerned about the NVIDIA quarter. We don't own NVIDIA. That said, we do feel the after effects of whatever happens with NVIDIA as it relates to growth stocks or value stocks or really just the market in general. But the good news is, again, that the percentage of stocks at a 20-day high has started to rise again. When we look at the rest of the market, so looking at the S&P 500 versus the NASDAQ 100, what we see here is the equal weight versus equal weight. S&P 500 has been acting okay, right? When we look at an equal weight basis. When we look at the NASDAQ equal weight, we are seeing a divergence in trend there. And again, we do think that's a reflection of what's happening at the very top of the market with names like Microsoft or Amazon or Nvidia or Tesla, right? We've talked about, this has been a big theme for us for the last few months, which is the top of the market is where we see the speculative froth. Now, that if we look across all the strategies that we manage, that has reflected in pretty good performance in probably 6 of the 7 strategies. The one in the growth strategy, you haven't really seen that pop in performance yet. We think that's coming. And the only reason why we think that's coming is because we think that as rates come down, we think growth stocks outside of the Mag 7 are set to benefit from that. And you can see that here with Microsoft. Microsoft's underlying trend continues to deteriorate. So despite the bounce in the S&P 500, the Russell 2000, the Russell 1000, global markets in general, Microsoft just continues to fade relative to the market. And again, very crowded long, great company, but again, coming off a very long period of high capital spending, and now investors probably want to start to see that reflected in higher ROIC or return on invested capital. That may take some time, and you may see the stock start to digest some of the returns that it's generated over the past year. We think that's probably a common theme across the Mag 7, whether we're looking at Amazon, Nvidia, Tesla, et cetera, et cetera. Now, all of this is a reflection, of course, of lower rates. As rates come down, and assuming, again, it's an assumption, assuming that there's not a recession that accompanies the lower rate regime, that starts to democratize returns across the market. So in other words, I don't need to pile into the same 7 stocks because I'm fearful of a recession, and I want to be in companies that have rock solid balance sheets and endless amounts of cash like the Mag 7 do. I want to be in the rest of the market that can benefit from a soft landing, that can benefit from easier access to capital, right? So what causes that easier access to capital? Well, lower interest rates. So we see here with the Fed Fund Futures, which is really the credit market's way of pricing in how many rate cuts they think are going to happen between now and the end of the year. That's gone from just about 1 rate cut to 4. Now, if you remember, when it was 7 back at the beginning of the year, we thought this is way too high. It's going to come down. And it did. And now we switched back in June where we thought, you know what? Inflation has started to ebb. We're starting to see signs of the economy slowing. Rate cut regime may be here. So that's what we are seeing. We've really nailed the macro picture. Now we just need to nail the portfolio design piece of the call. And we think that's coming here between September and the end of December. So we look at the 2-year yield and the effective Fed funds rate. The 2-year yield tends to lead where the Fed funds rate is going to go. We saw that in 2022. We saw that in 2018. So we do think that right now, that record spread between the Fed funds rate and the 2-year yield will catch up with the Fed funds catching up to the 2-year to the downside. And of course, if I can get this, if I can get my slide over here. So one of the things that we are seeing is a steepening yield curve as a result of all this, right? So a lot of talk about the 210 yield curve steepening. And there's a reason for that, because sometimes the 2-year yield can steepen for a number of reasons, right? We have what's called a bull steepener or a bear steepener. Now, a bull steepener that's accompanied by no recession, we think is pretty bullish because it's a reflection of the 2-year yield coming down more than the 10-year yield. And if that happens, you're getting a widening of the 210 spread. But it's a widening because cost of capital is coming down. Now, if both of these rates are plunging in reaction to a recession and the expectation that the Fed has to slash rates to rescue the economy, that's not bullish. But what we're seeing here is signs that the economy is slowing but not contracting, and signs that the Federal Reserve is going to lower the cost of capital quite a bit in a gradual and methodical way, and that the bond market is starting to sniff that out. And of course, that is for us, that's a big, big deal. Because right now, when we look at where the Fed thinks the implied neutral rate is, so the neutral rate, just as a reminder from last week, is that rate at which the Federal Reserve believes, again, a lot of this is Federal Reserve pixie dust, but nevertheless, it impacts their policy, so we need to know it. It's the policy that they think neither contributes nor detracts from economic growth. So the current Fed policy rate is 5.5%. The members of the FOMC believe that that neutral rate is 3%. So that implies that over time, this current rate cutting campaign, their target is to go from 5.5 to 3. So what does that mean for you? What could be the potential impact of lower rates? Well, first and foremost, for the average American out there, that should, in theory, lead to lower mortgage rates and lower loan rates. We looked at, if we see Affirm reported this week, and of course, that's a buy now, pay later type of company. They, of course, have already started to benefit from those lower rates. So the implied default rates in the future of people that are borrowing from that platform have already started to come down in terms of the implied default rates. That doesn't mean that that won't tick back up. It also tends to benefit smaller and higher growth companies. Why is that? Smaller and higher growth companies need money. They need access to capital. So what happens when interest rates come down? Well, I can borrow money at a cheaper rate, or I can access equity capital without sacrificing as much ownership as I would have had to a year ago. So it does tend to benefit smaller and higher growth companies. Also, lenders or people who have excess capital are more willing to invest in growth companies during a lower rate regime. It also helps companies, as you can imagine, with lots of debt. If I underlying debt load has an average interest rate of 8%, and I can shift that down to 6%, guess what? That adds a lot of enterprise value to the company, to the underlying company, because I'm paying less in interest, and that feeds down to my retained earnings. Lastly, tends to again, small cap emerging markets, because it's lower dollar funding costs, and tends to value growth stocks as well over those value or more defensive recession-proof types of companies. And we can see that the Russell 2000, we look at the small cap index, huge breakout earlier in July, then consolidated, had a big sharp pullback as we all felt in August, and then has again experienced another wide distribution day at 27-to-1 advanced decline ratio not this past Friday, but the Friday before that. Those types of breakout days are things we want to flag. Those are things we want to take note of and pay attention to, because they tend to indicate a change in regime. That when you see a 27-to-1 day, it's not a reflection of a parabolic top. It's a reflection of, I haven't been here and I got to rush to gain exposure because something's happening. That's historically what that has tended to reflect. So smaller companies, again, tend to benefit from that easier access to capital. So bottom line is, market breadth is expanding under the surface, which tends to be a symptom of market health. So when you look at the month of September, right? When you enter into the month of September with negative market trends, September tends to be pretty nasty. But when you enter into September with strong trends, kind of tends to be like any other month. So kind of a coin flip. Number two, momentum at the top of the market does appear to be fading in favor of the average stock. And that's really what you see reflected in our growth portfolios, in our blue chip portfolios, in our income portfolios, even in our passive sleeves, is that we are positioned for the average stock or the average growth stock or the average value stock relative to the top of the market. And then lastly, rate cuts do tend to benefit companies that need access to capital or versus those that don't. So that's what we got for you this week, 888-543-3776. Hope that everyone had a fantastic long weekend. And if you have any questions, again, please feel free to give us a call. We're here to help. And I hope everyone has a fantastic week. Thank you again.